So on your syllabus, there is always your question 4 in corporate reporting that talks about specialized transactions. So that place is about specialized transactions. And the specialized transactions are for 15 marks. 15 marks. Now, the specialized transactions that are 15 marks comprises of 2 major topics. Now we have 1, business valuation. And number 2, we have reconstruction. Reconstruction or reorganization. So we have the business valuation and the reconstruction. So my focus this morning is going to look at business valuation. Business valuation. Now, it is business valuation. And so what we are doing is valuing the worth of a business. Now, from the basics of accounting, we've been learning the accounting equation, the very basic of accounting. We've been learning the accounting equation. Now, from the accounting equation, we learned that there are resources of the business, which we call assets. And we also said that the assets or the resources or the rights of a business are provided by 2 people. One side, we call them the equity holders, and other side, we call them the liability. So it's either you provide it yourself or you borrow for it. This is the basics of accounting. Now, if we want to know the value of a business, the focus of our attention in this equation, which one do you think we will be valuing? Any idea? If we want to have the worth of the business, does somebody have any idea which one of these 3 elements we will be evaluating, which will mean the business, the worth of the business? Any idea?
So the equity.
The equity, that's good. So if we want to value the worth of a business, our focus is the equity. This is the worth of the business. Now, how then do we find the equity? Okay, we find the equity using the simple accounting equation. Equity, therefore, is equal to assets minus liabilities. I hope you agree with this change of subject.
Yes, sir.
So that is it. Now, there are other names to equity that you might maybe not getting familiar with. Another name for equity is from this equation that you see. The other name for equity, therefore, from this side of the equation is actually called net assets. Net assets. Because you see that if I have an asset and I deduct my liability, the net of the asset over the liability is therefore what we call what? The equity. So that is it. The equity, therefore, also is the business's value. So that is the value. The entity's value. Or the entity's net worth. Worth or net worth. So your focus in business valuation, therefore, should be on equity. So that is the idea. And even this same thing goes to consolidation. Because if you are going to buy a company, what you are going to buy is actually its shares. And its shares are its equity. So most of the time when you are doing consolidation and you are doing your workings too, fair value of net assets. Net asset. That net asset means you are doing equity. So that should be your focus. All right. So that said, that is good. We all know that equity is the residual interest of an asset after deducting its liability. So that is the meaning that you get the net asset. Now, with that said, let's look at some theoretical aspects of this class. All right, some theoretical aspects of this. So we pay our attention to the reasons why we value a business, and these are theoretical aspects of what we've been doing. So what are some of the reasons why? Of course, some of the reasons are that we want to, establish the terms of a takeover, because like the terms of selling something. Because the truth is that if you go to the market today, all right, if you go to the market today and say you are going to buy anything, you will see that the person selling will quote a price. The person selling the asset actually knows that the thing from his side it has a selling value of 5,000 Ghana cedis. But when you ask him, when you say you are buying something, what the person will do is that he will quote something like 7,000 to you. That is what you will do. Now, when they do that, the basis is that, or the reason behind it is that you that are buying, you negotiate downwards. So in Ghana, there is the statement of last cry a sing. I mean, what is the worst you can do for me? Last cry a sing. So you go like, okay, I'll pay. You go like, okay, I'll pay 4,000. Say, oh, 4,000 is not good. Increase it. Then you establish the bargain, but you realize that when you get to 5,000, the person will never go down again. That place, it becomes either you are buying or you are not buying. So we use the valuation to set that kind of terms of takeover or merger acquisition. We use it to determine the minimum price for negotiation. That is what happens, all right? And also to fix a share price for an initial public offer. I mean, an initial public offer simply means that you are actually going to the market for the very first time. I mean, the stock exchange market for the very first time. So in that case, because you want to fix the share price at the market, you value your business. All right. Again, we said that for investors to make buy or sell decisions, yes, of course, by that statement, it means that if you get to know the price, then it's either you are buying the thing or you are not buying, because per the price, you make your decision out of it. For the tax authorities, they use it to calculate capital gain taxes. Yes, because if I am able to value the business at this amount, then what happens is that if you sell it, then it means that I can find the cost. Then I can also find the value of selling the asset. Then I can tax you on capital gain. All right. So again, we said that where a major shareholder or director wishes to dispose of a large block of shares, of course, it's just like an IPO. If you want to sell, there must be a price, and you use the valuation methodologies to actually determine the price. Then here we said that when a company also needs to raise additional finance, of course, that one too is also true, because even banks need security. What is the value of your company? That if I give you the loan, in terms of anything, the selling of your asset, your net asset, can give me something to, defray the loan that I gave you. Then the last one is divorce settlement. I think for that one, if you have forgotten everything, that one you remember. Because we hear in this our Western world culture that people divorce and assets are shared. And so if you have business, it has to be shared. So there has to be a value of the business, so that if somebody is taking 60%, we know the exact value of that. So these are the reasons for valuing a business. These are the reasons for valuing a business. Now, these are theoretical aspects of it, but my major focus will be on the methodologies of valuating. All right. So if we want to value a business, there are three major umbrella and three main method under the one umbrella of valuing a business. So let's look at the methods of valuation, the methodology. Now we have basically, I'm going to group it into three, even though you may see the broad heading of two here. But in terms of teaching it, I'm going to just open it up small. All right. So in financial management, this same topic is taught, and I normally break it down into three. But the first one is the asset-based valuation model. Asset-based valuation model. The asset-based valuation model. That is quite simple. The asset-based valuation model has three methods and sub-methods. We have the net asset, and I believe that when I say net asset by this time, you know what net asset is. Because a net asset is E is equal to A minus what? L. All right, so that is where your mind should get to, because the word net asset is introduced. So we will need net assets value. So the net asset, all right. So if you are going to use the net asset value, there are you using the net asset, but in terms of the asset, you are going to pick only the book value. So this net asset at book value. At book value. What is book value? Book value simply means carrying amount. In times past, we used to call it the net book value. So that is what you actually see in the financial statement, the net book value or the carrying amount. So under this methodology, if you are looking for your net asset, which is your equity, the net asset is equal to assets minus your liabilities. All right, minus all your liabilities. So don't limit the liabilities. Liability simply means liability. All your rights minus all your obligations, whether long-term or short-term. Yes. So therefore, this part of the asset includes your NCA, NCA. This one too includes your NCL, NCL. All right. So that is that. With this net asset, another name for it, if you remember, in the early days of your accounting years, we used to call it capital employed. Capital employed. So we used to arrange our balance sheet in certain way, and then we used to use some capital employed over there. But and those days, those were our balancing figures. But you see that one, the carefulness you should take is that we used to do all the assets. Then when we are doing the current asset, we will less current liability. Then we get the capital employed. Yeah, that was how we were going about. But you have to be very, very careful. Here, we are looking at the asset minus the liability. All right. But the asset, the figures for the asset are the net book value. You pick it just as it is in the financial statement, just as it is. All right, the net book value, or these days, the carrying amount. All right, so you pick it just as it is in the balance sheet. You pick it. That's it. That's all. Book value. That is it. Then we have a case where the question will also introduce in the net realizable value. The net realizable value. So we have net asset, but the focus of the asset is at realizable value. Net realizable value. We know this. What is net realizable value? Net realizable value is the fair value less what? Cost to sell. You know it. So the fair value less cost to sell. So in this case, if you are looking for your net asset, which is your equity, by the way, your asset, the focus of your asset is the net realizable values, their net realizable values. And even on the liability, the same, but you just don't get it as such. But if you are giving the net realizable values of your liabilities, also pick there. But the caveat here is that you need to be careful about goodwill. Because per IAS 38, internally generated goodwill is not recognized. So please, if you have any internally generated goodwill, so what I will say here, the caveat that I will give here is that ignore internally generated goodwill. But you see, over here, we said pick book value. So whatever is there, you pick, including the internally generated goodwill. But here, what you are going to do is that you need to ignore internally generated goodwill. You need to ignore it. All right. And again, in terms of the liabilities, I'll go deeper into the liabilities a little, whether book value, whether net realizable value, or the last one, which is also net asset. The last one is also net asset, but the focus of the net asset, that one too is net asset. But the focus of the net asset, we are using replacement cost. What is replacement value? Replacement value simply means that how much would the thing cost today if I'm replacing it? Because figures are historical. How much would the thing cost today in the market? Today. All right. So here, the asset where you have your net asset is equal to those of all of your assets minus the liability. The focus here is that how much am I paying today? Please, it is current terms, today. So if I bought the thing 10 years ago, if I am buying it again today, how much is it going to cost? So that is the focus, replacement value. Now, this one too ignores internally generated goodwill. So please, you need to ignore. Let me not limit it to goodwill. It is internally generated intangibles, all right? Or internally generated intangibles, because those things are not assets. They are actually meant to be expensed. All right, so please kindly take note of that. Now, you realize that in all the net asset-based methods, there is liability, 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 liability. Now, what is the definition of a liability? We've learned in almost all of our classes, IAS 37, financial instrument, that liabilities are obligations, present obligations. Present obligations. Present obligation. The word present obligation means that it is unavoidable. Sorry. Unavoidable. So these are things you cannot avoid. Unavoidable. You can't avoid it. Can't avoid it. So that is the meaning of present obligation. Now, from IAS 10, and I think we had a very good discussion about that. Please, what you should know is that preference shares are not, from our study of IFRS 10 and financial instruments, preference shares are not equity. They are what? Liabilities. Please. Why do we say that? Why do we say that? We said preference shares are liabilities. Why? Because they receive a fixed rate of dividend. The company has an obligation to be paying them their interest. And when it is redeemable, you are under obligation to pay them their principal or their redemption value. When you are paying the redemption value, kindly check, because some of them, the redemption value will have a premium or it will be at discount. If you are doing the thing at premium, then it means that you need to pay the redemption value plus the premium. which means your obligation has increased. But if you are paying at discount, which means they will reduce the redemption for you. So you will be paying the interests and you also be paying the redemption, which is reduced because it is discount. But what you are supposed to understand is that because you have an obligation to pay the interests and also the redemption value, it is a liability. Take note of that. So the liabilities of a preference share includes its unwinding interest and what? Its principal. So the cash flow of this liability is the interest you have to pay and also the principal, which is at, so let me say the redemption. So the redemption, which is can be at premium, or it can be what at discount. So this is something you need to take note of. Now, that said, where can I find this interest inside the financial statement? That is where the issue of preference shares and issue of redeemable preference share and irredeemable preference share comes in. Because preference share, if it is redeemable, you realize that the interest, which is their return on a yearly basis, will be found in the, so as far as the interest is concerned, for redeemable preference shares, we will find it inside the P&L. The P&L. It's supposed to be in the P&L at what? Finance cost. As finance cost, interest. So therefore, if the question omits it and puts it inside the footnote, what you should do is that before you can find your profit after tax, you need to go back and deduct the finance cost. Because finance cost is deducted, you deduct it from the operating profit. So please bear in mind. But if the thing is irredeemable preference share, where can we find the interest? For irredeemable preference shares, they are treated similarly like an ordinary shareholders. And so their interest is found in the statement of changes in owner's equity. So their interest does not affect the P&L. Please take note of that. Their interest does not affect the P&L. It is only the redeemable preference shareholders whose interest affects the P&L. Irredeemable preference shareholders, their interest, you see, for that one, the redemption is not an obligation because it is irredeemable. You don't redeem it. Their redemption is not an obligation. So you realize that we treat them just like the ordinary shareholders. All right. So ladies and gentlemen, this is what you need to be very, very careful about. All right. So that is that. You need to factor these things in your liability calculations. All right. Now, the last thing I want to say about the asset-based method, and it goes generalized for all the method, is that when you finish calculating it, the answer that you get may be the total value of the company, or it will be the value of the company per share. Now, if you do the net asset method, because you are taking all the assets together and lessen your liability, what you realize is that your answer is the net equity, and that is the actual value of the company. So if you want the value of the company per share, then it means that you need to divide it by what? The total number of ordinary shares that are in issue. So the value of a company per share is the value of that company divided by its number of shares. So that is that. Okay. So that is it. So, and in case you just want market capitalization simply means the value of a business. And so therefore, if I want the market capitalization and if I have the price of a share, of one share, Then if I want the total value of the business, which we call the market capitalization, then it's, so you see another name for the equity is now what? Market capitalization. So if I now want the market capitalization, what I'm going to do is that I'm going to multiply the price per share over the total number of shares that I have in the by the total number of shares that I have in the company. Then I get the value of the company in total. All right. So that is that. Okay. The real value, the real worth of a business, which is the equity, for which we are using the methodologies of valuation for, is actually valuation is actually an art. It's an art. It is not a science, because like I initially started, if the person knows that the value is 5,000 and he start negotiations with you at 7,000, he is just hopeful he can get something beyond the 5,000, so that at the end of the day, the real worth is what you paid for. And so you will see that the real value of a company is obtained via negotiations between the parties, not really by your calculation. Your calculation gives you a basis, all right, for your negotiation. All right. So even though we are saying that you have valued the equity, when they are selling the thing, it depends on the face-to-face negotiation that they will do. This one says, I'll give you 10,000. So, oh, please, the thing is 15,000. At the end of the day, they bargain at a price. All right. So that becomes the real worth of the business. All right. But please, here, note that in this part of the exams, I've made a very important note. It is important to bring this out in the exams in terms of the real worth of a business and the fact that valuation, the final figure will be a matter of negotiation. And also show your understanding, all right, that valuation is subjective. All right. And sometimes one has to compromise between the two parties. Okay, if you say you have 12,000, then bring it. That tells you that what you are valuing is not the final figure of the value. And so therefore, what you are just saying is that tentatively, this is what you have. And so valuation, in terms of business valuation in your exams, is subjective. And I'll explain to you later when we are solving questions, because it gives room for subjectiveness. There are points where you will have to bring your subjective knowledge in it. So there may not be one answer for a question, because it gives room for a little subjectivity. All right. So now that is that. Now we've gone through all these things, the net asset valuation and all those issues in there. All right. We use it basically for asset stripping. What is asset stripping? If you are buying a company for the sole purpose of its asset, that is what we call asset stripping. All right. So if you are doing asset stripping, then it means the asset-based valuation method is very important. We use this to set the minimum price of a takeover. I think we've explained that. And most importantly, if the companies that you are valuing are property investment companies whose are predominant in terms of their assets, it is best you use the asset-based methodology. All right. So now let's look at how the figures work, or better still, let's look at the other methodologies. And once we finish with the other methodologies, then we zoom into the computations. All right. So this is what I will do. This is what I will do. So let's pick it up from here. The other methods, which is the income-based methods. So now we've learned like 3 methods from the asset-based. Let's look at the other methods. The other methods will basically focus on, let's say, income-based. Or better still, let me start from the dividend valuation methods. So we have the money-based methods, which is the cash, what we call the cash-based or income-based methods. Income. Here, we are looking at those people who are always thinking about how much they will get. All right. And the first one that we want to do is the dividend valuation model. Dividend valuation model. Number one is the dividend valuation model. When you are using the dividend to value the company. Now, the dividend valuation model is a mathematical formula. It says that the value of a company, which is PO, or you can say the market price per share of a company, is given by DO over KE. All right, this is the formula. DO over KE. But if there is growth, if the dividends are going to grow, then you extend the formula and do 1 plus G, which is the growth, or minus G. This is the formula. But let's understand the formula. You have done finance management a little. The DO here simply means dividend just paid. The dividend just paid. So that is the dividend. The dividend is just paid. In FM, we call it ex-div. All right. So the dividend just paid, we call it dividend just paid, ex-div. But we relate the ex-div with the cost of capital. So I'll come to that. So if dividend has just been paid, then it means that the cost of capital is what? Ex-div. If dividend is about to be paid, then it means it hasn't been paid. That one, we call it cum div. But here, we don't focus on that. It is in financial management, we look at all those things. But here, what you need to know is that DO is the dividend just paid, or the dividend paid. What is KE? KE is cost of equity capital. Cost of capital to the ordinary shareholders. Cost of equity capital. All right, you need to be mindful of that. And how do we get the cost of equity capital? We use the CAPM model, capital asset pricing model, which is KE. So this formula says KE can be obtained by risk-free rate of return, RF, plus the beta, whether systematic or unsystematic. So if it is both, then we use beta E, equity beta. All right. So you can just write beta because a company may not be geared, which has asset beta. But all you know is that you are using the beta in the question. So if the company, but the trick in there, which they don't go further unless you are doing financial management. If the company doesn't have debt inside, we use beta A, beta asset, ungeared beta. But if the company has debt in it, we use beta E. But here, they don't, bother you with those things. Then beta into bracket RM, which is the market return, minus what? RF, the risk-free rate of return. So this is the formula. But the caution I need to give you is that this RM and RF, this RM and RF is also called risk premium. Risk premium. So if you see, or market risk premium. So if you see a risk premium in the question, it means the one in the bracket has already been done for you. That is the meaning. It has already been done for you. You don't redo them again. It means it has been done for you. So that is how we find the KE. That is how we find the KE. It is the G that is troublesome. The G here, G here. The G is growth. G means growth. But the growth, we have two methods of finding growth. So you have to be very, very particular about the information given in the question to be able to determine which G is the question referring to. So here, G, we have the first method called the dividend growth model. The first method is called dividend growth model. The dividend growth model says that if I want G is equal to DO, which is the dividend just paid, over D1, which is the dividend that was ever paid the first time. Please listen carefully. So this one is, you can also say D1 over DO and interpret it the way you want it. These are letters, variables, all right? So don't say, oh, say I saw in a book the top was D1. You can even make it X, but you have to define the variable, all right? So the DO is dividend of the current year, the one that was just paid, all right? So please bear in mind, let me do it like this because I will need the other side. So I said DO over D1, where DO is the current year's dividend. And D1 is the very first dividend that was ever paid. All right, so that is it. Into bracket 1 over N minus 1. So that is how we find growth using the dividend growth model. But what is N? N is the number of times the dividend is growing. Dividend grows. The number of times, which in simple terms is the number of years minus 1. The very simple terms, minus 1. Or you can just say the number of times dividend grows. So let me give you an example. We have years: year 1, year 2, year 3, year 4, year 5. Then I have dividends of 5 cedis here, dividend of 6 cedis, dividend of 7 cedis, dividend of 9 cedis, and dividend of 10 cedis. Now, can you identify DO and D1 in this one? Can you identify it? This is the years, and these are the dividends. Can somebody identify that? DO and D1. We are trying to find growth. Anybody? Anyone?
Okay, so DO will be 10, and
DO
then
will be 10.
Then D1 will be 5.
And D1 will be 5. So that is that. So then we bring our brackets. Now, the tricky part is the N. We said N is the number of times dividend is growing. Can you give me the number of times the dividends have grown? Just try. I know I've not shown you yet, but just try. You may catch it. How many times is the dividend growing?
So 4.
4. That's correct. It's good you've been able to identify that. How did you get the 4? It is from here to here has grown 1 time, right? That's the first growth because it moved from 5 to 6. It grew. From here to here is growth 2. Here to here is growth 3. From here to here is growth 4. So that is it, 4. If you want it very easy, you can actually say that all the years involved is 5 years, and if I take 1 out, I have 4. All right, so basically that is that. Then you have minus 1. So can you compute this one and give me the growth? So that is how you find the growth using the dividend growth model. Can you give me the final answer of this one? So you said you have what?
189.
0.189. That simply means 19% or 18.9%. All right. So whichever way you can write it. All right. That's very good. So that is how you go by doing the dividend growth model. But what if I say that dividend, we are in 2023, and my dividend is, let's say, 8. And I tell you that dividend 4 years ago was 5. In terms of finding G, how will you get me the figures? DOD1, give me the figures. So dividend today, 2023, is 8, and dividend 4 years ago was 5. Who is willing to help?
The DO will be 8.
DO will be 8.
And then D1 will be 5.
D1 will be 5. Raised to the power 1 over n. What is n?
N will be 5.
N will be 5. How did you arrive at 5?
Sorry, 4. 4 years old. Sorry, it's 4 years.
How did you arrive at 4?
What is written at it? So that's 4 years ago.
So from today, 4 years ago means 4 years back. If you add it to today, it means 5 years.
Oh, okay.
Do you understand?
Okay.
But
Yes,
if
please.
it is 5 years, then it means the dividend has grown 4 times.
Okay.
Like this. 1, 2, 3, and 4.
Okay.
So that's why I tell you, you can use the number of years minus 1. So it
1.
is indeed
Okay.
4. All right. So that is the trick you may be having in the questions. So be careful. So that is how you use the dividend growth model to arrive at your G. But another way of also arriving at your G is called the Gordon's growth model. The Gordon's growth model. Now, the Gordon's growth model is a little bit tricky. It says that G is equal to R multiplied by B. That is what he proposes. Now, what is R? What is B? R, it explains to mean return on asset, ROA. ROA, or you can even get it in some books, return on equity. But the ROA, how do we find ROA? ROA from your ratios, ROA is profit after tax minus preference share dividend, i.e. the profit available to ordinary shareholders. Just like when we are doing the earnings per share, the top. Profit after tax minus preference shareholders, preference share dividend, divided by shareholders fund. Shareholders fund. What is shareholders fund? If you know your balance sheet very well, your equity side of your balance sheet, please, when I say equity, I mean those for ordinary shareholders. So if you see preference share over there, it is not equity. Please, we are focusing on shareholders. So all the capital contributions, all the monies for shareholders, stated capital, capital surplus, revaluation surplus, retained earnings, share deal amount, the equity, please, the equity side. Nothing preference. All right. And that is the shareholders fund. Now, what is B? B is the part of the money they retain. So we call it the retention. How do we get retention? Retention is obtained by 1 minus the payout ratio. 1 minus payout ratio. 1 minus the payout ratio. You see, this one, the answer you get is in percentages. This one, percent. This one, 2%. What is a payout ratio? See, payout ratio is simple. how much, you see, how much your share, you see, a share is the unit of equity ownership in a business. Unit of equity ownership in a business. So if you have a share, you are part owner of a business. So that is what a share is. Now, your share will work and it will get money in terms of profit. And when you earn that profit, you can find out the earnings per share so that everybody will know how much he earned out of the profit. And that is by IAS 33. Earnings per share. Now, if my share earns me money, it is called earnings per share. How much you are paying me out of how much I have earned is called dividend per share. Dividend per share. How much you are paying me out of how much I earned is dividend. So the payout ratio is how much you are paying me out of what I have with you. So it is DPS over EPS. When you do that, you see, this one is another valuation formula. This one alone, we will be looking at it very soon. So it's a payout ratio. So therefore, payout ratio is given by 1 minus, retention is given by 1 minus payout ratio, and payout ratio is given by DPS over EPS. And I want to make it simple so that you don't do it a memorization of formulas, so that when you go into the exam hall and you forget, you have a problem. I said the meaning of that is how much we are paying you from how much you have earned. So how much you are paying me from how much I have earned is payout ratio. So it's DPS over EPS. All right. So basically, that is that. So these are the two ways you can find growth. If you get these two together, you multiply and you get growth. Once you find all the variables to this formula, you now fix it in and you value a business. That is the dividend growth, dividend valuation model. We will be solving the examples, and I want you to bring your mind to it, all right, when we start dealing with the figures. All right, so let's just see if we can get a trial question to do. Let's see. All right, on this one. Now, look at these two illustrations. I think you can do justice with it. Illustration 7 here and illustration 8 downward. So look at this. Now, we've been asked to value the market capitalization. That is another name for the value of a company or the worth of a company. So, and we have been given the following. The company has share capital in issue of 4 million. So, share in issue, number of shares in issue is 4 million shares. The shares are not amount, they are number. All right. So 4 million shares is what we've been told. Then we have the current dividend just paid. We have the dividend 4 years ago. We have the current equity beta. Then we have the current market return. And we also have the risk-free rate of return. And we've been asked to value a business. We know that the value of a business, which is the MPS, market price per share, is given by DO, the current dividend, over KE, which is the cost of capital. And we have 1 plus G here, or minus what? G. So if we know that DO is, the current dividend is 24 pesos, which we can write in CDs like this. All right. Then what do we have again? 1 is 1. We need to find growth. We need to find growth. So G, per what the information we've been given, we can only apply the dividend growth model. So we have dividend 4 years ago. So we said that it will be 0.24 over the dividend 4 years ago, which is 15.25 pesos. This is how we write 15.25 pesos in CDs. All right. Raised to the power 1 over what? So this one will be 1 over what? Dividend was, we have this year and we have 4 years ago. So N will be what?
3.
N will be what? Please let me hear you. I can't hear you. N will be 4. Dividend 4 years ago. I think we just did an example right now. N will be 4 because current year is year 1. 4 years ago means 4 years back, which means total will be 5 years and the growth will be what? 4. All minus 1. So can you compute this and give me the answer of our growth? Let's be quick with it. So that gives us what? 12%, right? So 0.12. All right. So 12%. Now we know our growth. The next thing for us to find is our KE. KE. And the KE, we are told that it is obtained by the Kaplan formula. So which is RF plus beta into brackets RM minus RF. All right. So what is our RF? Please, RF is risk-free rate of return. Another way the examiner can put it is treasury bill. So you see, sometimes you need to apply your mind to the things. You should know that treasury bill are risk-free. You don't expect the examiner to just be pointing you to the thing, as in, this is it, this is it, this is it. You should know that per your knowledge of life, treasury bill are risk-free, except that in Ghana, is the only place that your treasury bill can have a risk. It's very unfortunate the situation we find ourselves in this time. So now, the question said the risk-free is 8%. So that 8%, we have 8%. And beta, current equity beta is 0.8. We have current market return to be 15. I've told you that the two inside here is called risk premium or market risk premium. So if that figure is giving you, you don't subtract anything again. You just put it in straight. All right, be guided. Then RF again, which is 8%. So how do we go about this? So if you work this one, what will you get? You get like 13.6%. And that is like 0.136. So that is it. Now, once we've obtained all the variables to our formula, the job becomes easy. So what is our MPS? DO was 0.24 pesos or 0.24 cedis or 24 pesos divided by KE, which we found is 0.136. Here is into brackets 1 plus G. What was our G? 0. So 1 plus this one will be 1.12 minus G, which is 0.12. So what is the market price per share of the company? So if you do it well, you have the down part is like 0.016. I think that is what you get. Then the top one is what? You have 0.24 multiplied by 1.12. That gives you 0.2688. And therefore, your final answer should give you something like 16.8 cedis per share. 16.8 cedis per share. All right, that is the market price per share. Now, since the company said we should find the market capitalization, I told you market capitalization is the number of shares of the company multiplied by the price per share. We know the price per share is 16.8. What is the number of shares they have in issue? 4 million. So if I multiply this by 4 million, I get the total value of the company. All right. And that gives me like something like 672 672. The zeros are 5. 1, 2, 3, 4, 5. So that is like 62,200,000. So that is the total value of a business. All right, using this methodology. So it's a systematic movement. You need to be very, very careful and cautious about how to derive your figures and plug them in. That is all. All right, that is all. Okay. Then we can take the second illustration, which I believe applies the Gordon's growth model. This illustration. So what is the illustration saying? So we have something like a company has the following. This one too has 2 million ordinary shares. The dividend per share just paid is 18 pesos. Current EPS is 25 pesos. Current return earned on assets is 20%. Current equity beta is 1.1. You also have the following information. The market return, is 12%, then risk-free is also 5%. So the same formula, this same formula is what we use. This is the formula to determine the price. But the DO in this case, is 18 pesos. So DO is 0.18. All right, so that is that. Then we need to find KE and growth. Given the information here, you cannot go and use this methodology for growth. No, you can't. Because you don't have dividend of previous years. You don't have it. So what is clearly applicable here is the Gordon's growth formula, which is RB, where we said the R is the return on assets. And if you look at the question very, very carefully, we are actually giving the return on assets to be what? 20%. Then we need to find B. We said B is 1 minus the what ratio? Do you remember? 1 minus what? 1 minus what ratio?
Payout ratio.
Payout ratio. So if it is 1 minus payout ratio, what was the formula for the payout ratio? Do you remember the payout ratio formula?
That's dividend per share over earnings per share.
So you saw in this question clearly, you've been given the dividend per share, which is so 1 minus 0.18 divided by earnings per share. You were also given the earnings per share to be 25 pesos, so 0.25. So that is that. So can we find growth in this case? So 0.18 divided by 0.25, 1 minus, so that one is 72 pesos, which means that 1 minus 72%, which means that 1 minus that will be like 38, Abby, or 28. So that will be 28%. So we have 20% multiplying 28%. So if you multiply that, that gives you like 0.056 or 5.6%. So 5.6%, and that is written as 0.056. So that is how you find growth. It's just that sometimes the examiner will not make it so easy for you. You know how to find R already, which is profit after tax minus preference shareholder divided by shareholders' equity. All right, so sometimes you have to also go through that to find. And sometimes the EPS will also not be given to you easily. You know how to find EPS. Profit after tax minus preference shareholders divided by the weighted average number of ordinary shares. So you will have to go and do that and come. Dividend per share is also dividend per share, meaning the total dividend of the company divided by the number of shares. So sometimes you have to go and find those things. All right. And that is where students will say that the question is difficult. It's not difficult. You are just refusing to go and work the other things to come and bring in. That's all. Because you know how to find each variable. That's it. Then how do we find KE? We still use our CAPM formula. KE, which is RF. What is RF in this question? RF is 5%, right? And what is beta? Beta, we are told, is 1.1. Then into bracket RM minus RF. Here we were given current market return. That is RM, which is 12%, minus the risk-free again, which is 5%. You see, I've told you that that thing into the bracket is called what? Risk premium or market premium. You see, and the examiner will bring it, and you will still get a student who will still do that, will take that one and still minus the RF. That is why people say the exam is difficult. It's not difficult. We give you all you need, all right? So when the examiner is doing his tricks, we actually try to tell you some of his tricks in the tuition. But it's just that some way, somehow, you may find a student who probably at the time you are making that important statement wasn't paying attention, didn't note it down or something. So when he goes there, he still uses the normal status quo and he's getting it wrong. Those are the issues involved. But if you follow suitly, I think you'll be fine. What will be our answer for the KE? What will be our answer? What are you getting? Because I have 12.7%. You can confirm that. All right, now that we have all the things we need, this one can be written as 0.127. All right. Now that we have everything, we just put them into our formula for finding our market price. So MPS will be given by the DO. What is the dividend they just paid? 0.18 over KE. What is our KE? 0.127 into bracket 1 plus G. We found G to be 0.5056, so that will be 1.056. Then here minus 0.056. So that is what we have, 0.56. So you do it and you find the price per share. Then you multiply it by the number of shares in issue. All right. So basically, that is what it is. So you may have here 0.19008. Please, you can point it directly on your calculator and write the answer to speed up things because time is of essence in the exam. So be very, very careful how you manage that. This one is 0.071. So if I do 0.19008 divided by that, I'm ending up with something, the share price of something like 2.68 rounded, because money is in 2 decimal places. So 2.68 cedis per share. Now, if I want to get the total value of the company, the market capitalization, I have 2 million ordinary shares. Therefore, I multiply by 2 million ordinary shares. So when you do that, you are around 5 point something. Okay, so 5.36 or 35% million. 5.35 million. So you can verify the figures, all right? Where there is an error, you just put it in there. My motive is to show you the procedure so that you can just get your values correct with that. So this is how we do the dividend valuation model. All right, dividend valuation model. This side is not packed. So that's how you do the dividend valuation model. So we need to pick up questions and be solving. Then that is how you can get yourself conversant with it. All right. So that is that. So let's look at the other formulas in the next 20 minutes. And in our next class, we will focus on solving problems of this business valuation. So let's look at the remaining formulas. So we have done the asset-based methods. We have also looked at the dividend valuation model. The dividend valuation model, we also have, using the dividend, we also have another one, which is called the DY, dividend yield, the DY. Right, let me change my board. So the DY method, which is the dividend yield method, is what you see. The dividend yield method is what you see. So DY is the D in this DY. The D is DPS. Y is what you get out of the market, which is yield. And so Y is what? MPS. All right, so that is that. But I told you that in valuing a business, the focus is on the equity. So what is a share? A share is when we say share, share is the unit of equity ownership. And we want to value that share. So our focus is this one, MPS. That is it. So if you are supposed to find a value of a company using dividend yield, then you do change of subject. So by change of subject, the MPS will be given by, if you do your change of subject where you realize that it is DPS over DY. All right, now this is it. But the caveat of using DY is this. You see, dividend yield is something from the market. But you need to read the question well. Is the question about a private company or a public company? Read the question well. Another name for a private company is an unlisted company. Another name for private company is what? Listed company. So get to know that. We are not talking about public sector. We are talking about public entities. And so therefore, if it is a public company, you will get its DY easily. So it will be what the question has given you. But if it is a private company, you can't get a DY for a private company because they don't trade their shares from the market. On the market, they don't. So if you are valuing a private company, then it means that you pick the DY of a public company, which the public company can be the parent who is buying the other. It can be the proxy, a proxy public company, or it can be the industry's average. Can be the industry's average. So if you are valuing a private company, the DY will be sourced from somewhere. Okay. Then when you get the DY, I mean, how will you get the DY? This is the formula for the DY. So you look at that party's whose DY you are going to use and look for this information for that party. All right. And when you go through and do the DY, when you finish getting the DY of a listed company, the DY, so when you get the DY of the listed company and you want to use it for the unlisted company, you will scale it up. So the DY of an unlisted company is equal to the DY of a listed company that is scaled up. Please, the scaling up, it is subjective. You can do it yourself. What do I mean? So for example, if I find the DY of a listed company to be 20, I find the DY and it is 20%. I will scale it up, meaning that I can use any figure that is above 20%. So I can scale it up by 10% or whatever percent. Please, it is up to you. If the question wants a uniform answer, he will give you the percentage for scaling up. All right, for the scaling. So if you are scaling it up or increasing this one by 20%, for example, you multiply it by 1.2 and 20% increasing, or somebody too will do 20% of this and add it back. Please, all those things waste time. So if you want 20% that has been scaled up by 20%, then it will be 24%. So that is it. You increase it by an additional 20%. So that is the meaning. You scale it up. Why do we scale it up? Why do we scale it up? Dividend yield is how much you are getting, how much dividends you'll be getting from how much you trade on the market, or your shares that you trade on the market. Now, for a private company, they don't. So if they don't trade in the market, so the public company does. The public company does. Why we scale it up is that, you see, for a private company, when they make profit, they can sweep all the profit as dividends. They can pay themselves dividend because the money, the company is like them. When they get a profit of 10,000, they can say they are paying dividend of 8,000. They don't care because they want to pull out their money quickly. But for a listed company, what normally happens is that they want to increase their value. So you see, they will reinvest the profits they get. So they don't pay dividends like that. They pay small dividends so that they will get more retained earnings to push the business forward. But for a private person, he can take more of the dividends. So the rate of dividend payment in a private company is more. That is why we scale this thing up. All right. So when you get the public companies own, scale it up. All right. So that is why we scale it up. So once you find the DY, so assuming this company is an unlisted that we are valuing, this DY will come from a listed company that has been what? Scaled up. Then you come and apply the DPS of that private company. So please don't repeat the DPS here. The DPS you used here was a proxy company or the parent company or the industry's average. That is the DPS that you used here. All right. That's the DPS that you use here. Then you divide it by their market price per share. And please, market price per share simply means the total value of the company divided by the total number of shares. So you know the market capitalization. When you divide it by the number of shares, you get their MPS. MPS is value in a business divided by its number of shares. So if you find these things from the proxy, so these things that you are doing is from the proxy. When you finish, the only thing you get out of that is the DY of that proxy. All right, the DY of that proxy. Then you come and insert it to your private company's DPS. So this one will be the one for the private company. So that is how we use the DY to find the value of a business. When you find the MPS and you want to know the total market capitalization, you can multiply it by the total number of shares. Please, is that understood? Is it understood?
Yes, sir.
All right. Let's quickly look at the other formulas, then we go. We have PE ratio. The earnings, we have PE ratio. Using PE ratio to also value a business. PE ratio. Now, if you are also to use the PE ratio to value a business, the P is price, so it is MPS. The E is earnings, so it is what? EPS. So this is the PE ratio. But I've told you time and time again that when we are valuing a company, what is our focus? It is the MPS, is that not it? So if you do change your subject from the EPS ratio, you realize that it will be earnings, the EPS multiplied by the PE ratio. The PE ratio. Now, again, here too, the value is the same. You have to get to find out that is the company a listed company or an unlisted company. Because if it is an unlisted company, then it means that this PE ratio should be a PE ratio of the parent or of the proxy, that is, or the industry's average. What I'm trying to say is that you use the PE ratio of a listed company. All right, of a listed company. Because if the company that you are valuing is is a private company, you need to use somebody's P ratio. Once you get the P ratio of that listed company, please, this one, you scale down. You scale down. All right, you scale it down. The scaling down, the examiner will give you the percentage for scaling down, or it is left to your subjectivity. This is where I told you that business valuation has subjectivity inside, depending on the question. So P ratio, we scale it down. We scale it down. Why do we scale it down? P ratio is about the profit. It's about the profit. And for a private company, what happens is that their internal control system is very poor. So the likelihood of manipulations in profit will happen is very, very true. Controls are not the same. So you see that their profitability side is not that good because of lack of controls. All right. And the tradability of their shares, because their shares is also not tradable. Hardly would they get, are they likely to get income from the market? So you scale it what? Down. But once you finish, so how do we find the P ratio of the listed company? This is your formula. So you are going to use this information of the listed company. Once you finish, the answer that you are getting to bring into the private company's valuation is only the answer you get, the P ratio. But this earnings, you know what earnings is? Earnings is profit after tax. All right, minus preference share dividend. Minus preference share dividend. Please, that is earnings. Because we are valuing the equity side of the business. Equity. Preference shares are not equity holders. So please be mindful. All right. So once you get the P ratio of the listed proxy company, then you come and multiply it by your earnings per share. All right. Then you get the value of the private company. Assuming you were valuing a public company, it would have been easy. That one, you don't scale anything. Just as you use this information. As you do the change of subject, you take the information from then and then. So be careful the company you are valuing. All right, just be very, very careful. So this is how we also use the PE ratio to value a company. All right, the last one in terms of these methods is the EY formula. The EY, we call it the earnings yield. So in this one, E will stand for what? E will stand for what? I've been showing you the easy remembrance concept. E will stand for what? What do you think E will stand for? Somebody should try. E. What is E? When you hear E, what comes into your mind? Yes, anyone, please. Are you guys there?
Yes, sir, we are here.
So what do you think E will be for? The E part of the formula, what do you think it will be for? What was this E for? E in the formula, what is it for? E, please. What is the E for? So as you see in here, the E is for earnings per share. Then the Y, like you saw in the other formula, Y is the market, so MPS. So now if you therefore want to value a business, your focus is on the MPS. So if you do change of subject, you realize that the MPS will be equal to EPS over EY. All right. So that is that. Sometimes the yield will come with growth. So if there is growth inside the yield, then it will be the formula with growth. And it goes for the dividend yield too. Anytime there is growth in the question, then it means that all you are going to do is, just like the way we did the DVM model, you will do the earnings per share here, 1 plus G all over EY minus G. So just as you did in the DVM model, the same thing, if there is growth. Now, the same idea also pans out here. The same idea pans out here. Which company are you valuing? If it is a private company, then it means that this EY inside the formula, which is obtained by doing this, will be for a listed company. And since this is EY, we scale up. For every yield, we scale what? Up. You scale it up. All right. So basically, that is that. You scale it up. All right. So that is that. Then you come and apply it in the private company's formula, which is this side. All right. So basically, that is that. All right. So this is what you go in there and do. Then the very last way of valuing a business, that's the last one, is called the discounting cash flow. Discounting cash flow model, DCF model. Discounting cash flow model. Please, this one, you need to do NPV analysis. But in corporate reporting, the way the examiner puts it makes it very, very simple. Now, watch this. When we say DCF, if you have done financial management before, DCF is cash flow. So anything that is not cash flow, you will take it out. It's based on cash flows. It's based on cash flows. You take it out. So what are some of the things that are not cash flows? Especially, we have depreciation, we have provisions, estimations. All these things are not cash flows. So in terms of doing the discounting cash flow, you need the net cash flow. So if you know how to do an NPV, what we are looking for is your net cash flows. Net cash flows, once you get the net cash flows, then you discount it. All right, you apply the discount factor. So apply, so the net cash flow multiplied by the discount factor will give you the present values of the earnings. And that is the value of a business. If you want the value of the business per se, you do that. Now, what is net cash flow? Net cash flow is actually called your profit after tax. Profit after tax. So as an accountant, you know how you get to land at your profit after tax. I know you know. Sales, less cost of sales, then less operating expenses. You add investment income, you less finance cost, then you tax it. But the danger in this determination of profit after tax is the concept of depreciation. Please, depreciation, when you are using discounting cash flow, depreciation is not a cash flow, so you need to ignore it. So if before arriving at the profit after tax, the company deducted depreciation, please, you have to add the depreciation back so that it will erase it. If they deducted, you add it back so that it cancels off. Depreciation is not a factor of cash flow. Please listen and listen carefully, because these are the things that normally distinguish the one who will pass from the one who will fail. Because the instruction is simple. We said that depreciation is not a cash flow. So if before arriving at the profit after tax, the entity had deducted the cash flow, we said it shouldn't have been. So you go back and add it so that it will erase the depreciation. So that is that. So that is the only trick there. Then another trick is this discount factor. There are two types of discount factors. We have post-tax discount factor and we have pre-tax. Now, I've told you in your course in doing corporate reporting and FR already that in FR and CR, we don't use the post-tax discount factor. When we were doing the something like calculating our VIU in IAS 38, I make mention of that, post-tax and pre-tax. So in doing anything of the standard, you use pre-tax. Why? Because tax has a standard on its own. We don't use post-tax. We use what? Pre-tax. But when it comes to business valuation, you could see there is no standard we've mentioned here. It is not actually not a corporate reporting course topic. It is actually a finance management topic. So here we don't use pre-tax, we use what? Post-tax, please. So here you use the post-tax discount factor. All right. So please take note of that. We use post-tax discount factor or annuity factor. Please, in business valuation, we don't use pre-tax. Please, we don't use pre-tax. We use post-tax. Apart from business valuation, any other thing you do in corporate reporting or financial reporting, we use what? Sorry, I've actually changed it. So, apart from, I've already said here that we use post-tax in business valuation, post-tax. We don't use pre-tax in business valuation. Apart from this business valuation, any other thing you will do in corporate reporting, you'll be using pre-tax. I hope I've made it clear. So please take good note of that and correct yourself when you are doing it. So if it is anything you are doing standard, IS that, IS this, IS that, and everything that you do, you will be using pre-tax. But in business valuation, we use what? Post-tax. All right, risk-adjusted post-tax, not risk-adjusted pre-tax, post-tax. This is because we are doing business valuation, and it is a borrowed topic into the reporting. It's actually finance. All right, so that is that. So you'll be multiplying the figures. So you get your PV of your earnings. All right, then you total it, then you get the NPV, which is the present value of the PVs, which is the value of a company. So ladies and gentlemen, these are all the methodologies in valuing a business. What I need you to do is actually take your time. When the video is shared, you can actually go over, because the next time we are meeting in this class, it will fully about solving past questions. So the past question will tell you that apply this formula to value a business. If you have time, you can actually go and take the past questions they wrote just last sitting. You realize that it's very cheap, 15 marks. You are using the various methodologies. So the question will tell you which methods to use. So like this one, asset method, price earnings, which is P ratio, dividend yield, discounted cash flows, just like what we did. So you see the discounted cash flows. He gave you the profits. These are the profits. And it says that the estimated profits, so this is a quick question. The estimated profits before tax figures are arrived at. So this one, he didn't give you the profit after tax. He gave you profit before tax. So profit is profit, whether after tax or before tax. And it says that they arrive at the estimated profit before tax figures. So they are arrived at before charging depreciation. Before charging depreciation. So this one, will you add the depreciation back, or you will leave it like that?
No, you will not add.
You will not add.
No.
So you see. So you have to read the question very well. Okay, you will not add. So all you need to do is take these cash flows, then apply the discount factor. So what will be the discount factor? The discount factor will be given in the question, or when you read through the question, you'll find a discount factor somewhere. in the question. So please, that is it. Have you seen the cost of capital of any DASO? 10% for your discount factor. So you use 10%, then you PV them. Once you PV them, that is your answer. That is your answer. But you see, you have to be very, very careful with the requirement of the question. It says that determine the value to be placed on what shares? On what shares?
Each share.
Each share. So once you have finished valuing the company using this, the discount factors of PV in this figure, you now need to divide it by the total number of ordinary shares of any DASO. So you have to find that. You have to find that. The number of shares probably is up there somewhere in their balance sheet. This is the share capital is 50,000. When share capital is 50,000, they told you that the ordinary share component is 20 pesos and 40. So what do you think will be the number of shares of this company? How many number of shares do you think they will have?
40,000.
It's not true. Please, the 40,000, is it in CDs or is in number? I said, how many number of shares? You said 40,000.
Okay.
That figure there, is it in CD or is in number?
It's in CDs.
So how can that one be a number of shares then? So you see, you need to be careful.
Yes, sir. Yeah.
So you need to be very, very careful. They gave you the price. They gave you the price. So if you want the number of shares, and please, this is how consult is. So these are the basics. So if the share price for each is 20 pesos, okay, the share price of each is 20 pesos per this question, 20 pesos. Okay. And the total shares gave 40,000. What do you think was the number of shares that brought you to this 40,000?
So it will be the 40,000 divided by the 20 pesos.
Aha. So how many shares will you get from there? This one will be like 200,000, right? So
yes, it's 200,000.
200,000. Aha. So that's how you find number of shares. So like I always tell you, don't always expect the examiner to be pointing you. Please, this is the figure. Pick me, pick me, pick me. Sometimes you need to work your way around it. Okay, so that is how you find the number of shares. So when you do the asset-based method, so find out in the asset-based method of this question, are we supposed to use book value, realizable value, or how will you know? You see, you have all the assets here, starting from here to here. And from that, if it is book value, you will know. If it is a realizable value, you will know. You will know from the footnote. You will know from the footnote. So this one, this is the first part of the footnote. It is not about the asset. This one too is not about the asset. This one is about the asset. They said that the patent in the SOFP represents license to produce improved variety of the product, and it is expected to generate a pre-tax profit of 10,000 per year for the next 5 years. So this one, they are actually valuing they are actually valuing the patent. And this statement, I told you, internally generated intangible is not recognized. But you could see from this one that it's not internally generated. This one is IAS 38. It is research and development. This one tells you that the patent is developed because it is expected to generate pre-tax profit. If you remember your IAS 38, I told you that we use the concept of pirates. Then the last thing of the pirate said, the thing is expected to be beneficial. That's what they've told. That's the clue they've given you here. So it means you need to capitalize the 10,000 and do annuity factor, PV it for the next 5 years. So you will solve this question. So you apply, you PV this thing over future 5 years. And that is you applying the annuity factor. All right. So even though the patent here is 8,200, it means ignore this one. It is internally generated. Ignore it and apply this one. The 10,000 represents a license. Do the PV of the 10,000. All right. I mean, find it. Present value of that. Find it. It's 5 years. So you apply annuity factor. So once you find it and you add all your assets, that's all you do. You've added the asset, then you take away the liabilities. So the liabilities, to be careful. What are your liabilities? These are your liabilities. All your liabilities. All right. Then you take away your liabilities. Then you have the value of the company divided by the number of ordinary shares. So that is what we will be doing. So you see the examples. You see it in there. The formulas the question will tell you to use. So before we meet, it is my advice that you actually be conversant with the methodologies so that when we meet, we are able to solve the past question with ease. So this one too, as you can see, dividend per share, earnings per share, you see all those things quoted in the market. You see it, you see all these things. All right, you see all the figures that you need. You are asked to use the net asset 5 marks, price earnings, dividend growth model. That is how it is. So when you get it, it's very, very easy so far as you know your formulas. And sometimes some of the things inside the question too, you may have to do 1 or 2 adjustments. Like for example, at the end of the year, allowances based on lifetime expected credit loss was this. So if before you value an asset, the receivables in there, make sure you have applied the IFRS 9 expected credit loss. So this is why people say the thing is difficult. You don't need to forget that you have learned IFRS 9. You just come and apply it. That's all. So you apply the IFRS 9 to situate the figures as in where they should be. Then you just go on and do it. Just as when we are finding KE, we have to use the Kaplan formula. When you are finding this, you have to use this formula and that to come in. The same thing, when the thing is about the standard two, you have to. All right. So you are using the asset base, earnings base, dividend yield. All right. P ratio. Let's say that is it. Then that will be it. So take a look at the current one they wrote in March 2024. You realize that it is also the same thing. All right. So I hope you will run through that before we meet. All right. So thank you very much. We will meet in our next class.